Hi, I'm Jeff Gitterman. This is Investing for an AI Future. It's also allergy season, so pardon my throat. Thankfully, I'm just the moderator and won't be doing most of the talk. I just want to set the stage for the fact that I am historically, for those of you that know me, extremely focused on climate change and climate risk. And we realized really in the last 2 years that we can't be focused on climate change and climate risk and not also be focused on AI. I like to quote Thomas Friedman, who said in a New York Times editorial that the two greatest risks or threats to mankind are climate change and AI. And the only thing we can hope for is that AI solves for climate change before it's too late. So in that vein, we'll talk a lot today about kind of energy demand. We talk a lot in our conferences and seminars about the addition economy. We wish we were in a transition economy, but we haven't been in a transition energy economy since we left whale blubber for oil. And since then, we have just added, really whale blubber for wood almost, but since then, we have just really added different energy mixes and sources. We are doing more renewable energy annually as a new source of energy in the United States, but it is still not dramatically cutting into the amount of fossil fuel emissions that we're seeing on an annual basis. And AI is ramping that up incredibly. I was going to use a chart, but I'll just speak to it quickly. The AI demand is changing. Annual US energy demand and growth from about 2% annually historically, we've almost been flatlined on US energy growth, to potentially 6 to 8% energy growth. Right now, AI makes up about 1.4% to 1.9% of total US energy electric consumption. It's projected to grow in the next 2 years to about 7 to 12% of US energy capacity. So with that, I'd like to bring in our guests. We have Alex Monk from Schroders and Robin Cullener from ScopeFour Capital. Welcome to our panel, guys. I'll start. Yeah, sorry. Why don't we start with Robin? Give a brief introduction of your role, the great company that you work for, ScopeFour Capital, and tell us, a little bit about yourself quickly.
Sure. Hi, Jeff. Appreciate you having me on, and hi, everyone. I'm Robin Cullener. I'm a portfolio manager and partner at ScopeFour Capital. We manage a public equity portfolio tied to tangible climate solutions. So we're actually directly investing in everything you're talking about, Jeff. We're looking at wind companies, solar, we're looking at the EV space, we're looking at grid infrastructure, energy transition. And counterintuitively, it's actually a pretty exciting time right now with just the way the markets are behaving. So I think it's going to be a topical conversation,
Awesome. Thanks, Robin. Alex?
Yeah, so very similar to Robin, investing in public equities across the, energy landscape, and specifically on the sort of the sustainable energy side. So looking again at renewables, bits of grid, batteries, hydrogen, sort of energy storage, you name it. And I'd agree with Robin. There's obviously been, a sort of, difficult period for this space over the last couple of years. Particularly maybe post the sort of bubbly valuations that we got to in sort of post-COVID, but actually under the surface, there's lots of actually quite exciting things going on, specifically around energy demand, AI, particularly load growth. So really looking forward to the conversation.
So I'm going to stay with you, Alex, for the first topic or question. And I always like to remind people that under Trump's first administration, fossil fuel companies did terribly as an investment, and clean energy companies did incredibly well, probably the best 4 years they had. And then under the Biden administration, fossil fuel companies did incredibly well. We actually, I think our output on fossil fuels was the highest under Biden. And then clean energy companies did terribly. Now, part of that is an interest rate cycle because clean energy companies don't do well. But here we are back in the Trump administration, year to date, clean energy companies are actually doing quite well again. So Alex, when you're looking across this space, what are you seeing around energy capacity and energy demand? So what's being built out currently that you're seeing? Where are the investment cycles that you're kind of looking into?
Yeah, I mean, maybe just to sort of pick up on your first point around, I guess, the relative performance of I guess, conventional energy and sustainable energy at different points in the cycle. I think, historically in this space, we've often seen a bit of buy the rumor, sell the fact, and often in the build up to new administrations coming in, you see kind of that pressure and certainly that pressure weighing on shares. And I think we certainly saw that in the case of sustainable energy a little bit last year in the build up to the election and maybe post election. But actually, then you get to that point, and all that negative sentiment is baked in. And people start to forget that actually under the surface, these are still parts of the market that are growing, even in a difficult policy environment. And we've kind of always said that there are three things that drive earnings growth across the sustainable energy landscape. One is policy. We need to accept that this is a space that does require some policy support, but also it's the fundamentals. And those fundamentals are really based around cost. And consumer and corporate demand. If stuff is cheap enough and enough people want it, stuff gets built or stuff gets bought, and that's what drives earnings growth as well. So I guess that leads into your question around what are we actually seeing on those two pillars of cost and consumer demand, and what is actually being built. And maybe we start in the US, and then I'm sure we can expand sort of beyond that as well. And you mentioned obviously that we're seeing load growth in the US for the first time. And I think when we talk about load growth, and obviously the topic of this conversation is very much around AI and data centers and sort of the energy demand from that, but load growth is happening in different buckets as well. There's simply population growth, consumers getting wealthier. We've got more heating and cooling demand as climate change starts to happen. EVs are slowly growing as a share of the overall fleet as well, which is contributing to that demand as well. So I think what we're seeing is that, yes, data centers is a big part of that, but there's also other load growth too. Now, if we think about what that means for renewables, we are obviously seeing a bit of a renaissance or kind of comeback in things like nuclear and gas to feed data centers directly, and I'm sure we can unpick that a little bit as part of this conversation. But I think what's also important is that, again, coming back to that cost and consumer demand point, renewables are still the cheapest and quickest way of bringing new power to market. If you want to build a new gas turbine greenfield from this point today, you're probably waiting till post 2030. Exactly the same with nuclear. So if you want to build a data center over the next couple of years and you haven't got an order in the queue for one of those other technologies, you've got to go to renewables. And actually, even if you wanted to do gas and nuclear, there are some cases now where actually renewables and batteries, particularly solar and batteries, but maybe some wind based in there as well, again, just makes sense from an economic perspective because of how cheap and how quick you can build this stuff and get it to market. And then on top of that, as I say, yes, we need baseload power, again, gas and nuclear for data centers, but then there's this other big pool of load growth as well, where actually renewables are a very effective solution because you don't necessarily want baseload power. You want that flexible power to meet sort of load profile. So again, under the surface, I think it's important to note that we're still seeing pipelines and order books for solar grow. Wind, US wind is, I think, going to have some of the best years it's had in a couple of years in terms of installations over the next couple of years after sort of a little bit of slowing down from permitting issues and inflation and interest rates, as you mentioned. So again, we're seeing that in the US and we're seeing it in Europe as well. But I'm going to pause there because I say you can go on about this for a while. But
Robin, maybe you could touch, since I know you're focused mostly US, correct?
Yes, and also US as well. We have a global.
Okay. Yeah, so maybe you could focus a little bit in the same kind of topic generation, but around some of the risks of the current administration, potentially around things like wind and clean energy, where you're seeing the best investments, barring that potential risk coming from tariffs, administration policies. I mean, we're in a time of a little bit of investment chaos, and how is that impacting your investment themes related to AI and these particular sustainability themes that you're focused on?
Yes, absolutely, Jeff. It's a complicated time, as we all know, and it seems like the news flow is coming fast and furious as well. So you always have to alter your assumptions as the new news flow is coming in, right? But what's interesting is that we spend a lot of time analyzing the first Trump administration, what actually happened with policy as opposed to what they said. And we saw a lot of pushback, for example, from the states, right? And a lot of the wind and solar type of build out in the US happened in red states, where it was a great jobs creator, for example, that really helped the local economy. So we saw some news flow over the past few weeks of a lot of groups on the right trying to plant that seed, saying we're going to push back, and if there's going to be any activity trying to roll back any type of project, we're going to sue or we're going to go down that path. And they had a lot of success actually doing that, right? So which is also why you saw the clean energy space do really well in the first Trump administration, because the fear caused a sell-off. And then you went back to seeing what was actually happening on the ground. It caused a huge type of rebound on these shares. What's more important is, and I think Alex also touched on this, is that the economics are a lot better than they used to be in the first Trump administration. So, for example, wind and solar costs are down close to 30 to 40% from that top, right? And you're seeing also EV also become a lot cheaper, batteries are cheaper, so on and so forth, right? So now you can really make a strong economic argument for doing this, which I think will overrule the harsh type of policy initiatives that could be at play. So that's one thing that we're pretty optimistic about, is that they are going to hold the line on that, and we're seeing some early type of stages on that. What's more important is also when you look globally, and we know that climate change is a global issue, right? It has no borders at the end of the day. And even though you may have some policy type of worries in the US, non-US, there's a lot of very positive green shoots happening. We're seeing that in Asia, we're seeing that in Europe with also elections, and we're seeing a lot of actually CapEx spend from the ground move very quickly. And to your point on AI, we just saw the news flow on DeepSeek happening in China, which kind of altered the CapEx investment thesis in this place. And a lot of people are now going back to their models and saying, all right, now we need to actually rethink cost of the CapEx here, which is, for us as investors, that's an opportunity set in that uncertainty and volatility to actually take advantage of what we think the next 5 years are going to look like, as opposed to the next year.
Maybe we could go right from here, and we'll start with you and then move to Alex on this topic of what is the AI actually demand scenario doing to our grid infrastructure. So we're talking about adding energy supply, but at the same time, and maybe you could, just for some color, help people understand the fact that we can't just throw a nuclear power plant up anywhere. We can't just throw a natural gas turbine anywhere. We can't put a solar field, anywhere. It's got to get tied into this grid infrastructure that we have, whether it's in Europe or the US. What is AI doing to that demand? And where are we even prior to AI in that capacity of the grid before we even add all of this new energy onto it?
If you remember that show, Star Trek, Scotty the engineer would always say, I got to have more power, Captain, right? And that's exactly what's happening here, is that we need more power for sure, right? And grid infrastructure is antiquated. We know that it's close to 20 to 30 years old for a lot of the guts of the grid. And we know there's a queue issue as well, where there's a lot of projects in queue hoping to get added on, which is a few years wait in both actually the US and Europe. On top of that, you've got data centers that are growing and also growing fast. We're seeing all the CapEx spends from the likes of Amazon and Microsoft and Google, and they're spending quickly, right? We're seeing the investment from SoftBank and a lot of investments coming into the US to grow that baseload, right? So then you've got a conflict. You've got an older grid that has to be upgraded with a lot of new type of voltage lines and power transformers and a lot of cables and so on and so forth. And you've got all these queue issues. On top of that, you've got the load increasing. It's a problem that's going to require multi-pronged approach from both industry and government to solve, right? This is not a political issue. We need more power as a country, right? So being able to solve that, I think, is going to be crucial to national security in the US and how we grow our GDP, as well as how we play in this AI space when there's a global competition, right? So it's not pretty, Jeff. There's no short-term type of solution as well. We know, though, there's a lot of CapEx and innovation happening in the space as well. Alex, I'm sure you've seen this too. Everybody from the private market players to VC to the public market players are throwing a lot of capital at this. Where it gets complicated and what you need to worry about is actually tariffs, which you also touched on as well, Jeff. I mean, for example, large power transformers that go into a grid, the majority of that comes from overseas. Some of them come from Mexico, for example. So how that tariff situation is going to impact that queue issue and just the need to upgrade that infrastructure, that's a key question that investors have to answer. I think it's in the stocks. If you were to ask me intuitively, I think the market's already kind of factored that in. So there's not much more type of downside here, but it is a cause for volatility at the end of the day.
Yeah, I want to stress, and then I'll pivot to Alex for a second, that when people have thought for the last 4 years under the Biden administration about clean energy, it's really been a climate issue only. And now, all of a sudden, because of AI demand and the issues that we've just spoken about around nuclear and natural gas, to an extent, clean energy is now an AI play, even if you're not interested in it as a climate change play. So I think for a lot of investors out there, and especially a lot of advisors that listen to webinars like this is no longer just a clean energy play. Clean energy is now an AI play. So you have to start thinking a little differently about this. Alex, I think it's a good time to bring in DeepSeek, which, Robin mentioned during, while he was speaking. A lot of people, just all of a sudden when they heard about DeepSeek said, oh, okay, all this energy demand is out the window and we don't have to worry about these huge, uptakes in energy capacity that are needed because DeepSeek, met these challenges with a 100th or a 10th, whatever it might be, of the energy usage that ChatGPT and Grok and other tools were using. Can you speak to maybe the facts about that and the risks of, thinking that is really the new world that we're in all of a sudden just because one company came out with different metrics?
Yeah, DeepSeek, I think, was a really interesting, moment in time for a couple of reasons. Now, maybe let's start with the kind of first building block of what did DeepSeek really tell us? And to be honest, it was a relatively information light announcement in that actually there wasn't too much evidence around it. Like, yes, they've clearly built, but it wasn't totally clear to anybody exactly how much training had gone in or the way they trained the model. So I think that's the first thing to say in terms of kind of stepping back. The second thing is that just because we invent a more energy efficient way of training AI models and large language models doesn't mean we necessarily won't use the same amount of power. There's a concept called Jevons paradox, which essentially means that as we make things more efficient, we simply just use the same amount of energy but do a lot more stuff because we can do it much more efficiently. So I think that's the other thing that's kind of interesting as well. Why I think the market got a little bit spooked out about DeepSeek, particularly in US markets, and particularly a select handful of companies, actually not in the renewable space. I remember this very, very well because I was on holiday and I was checking to see how the sort of solar and wind space would react to the DeepSeek news. And actually what was fascinating was it was up on the day, whereas actually we saw companies maybe more exposed to gas and nuclear and the grid down quite heavily on the day. Now, part of that is valuations, and I'm sure we'll touch on this as we go, but actually there has been quite a big disconnect between sort of gas, nuclear, grid, and I guess what would be classed as sort of that sort of more sustainable, renewable energy bucket, and then sort of a big divergence of valuations there. But the other thing that I think DeepSeek raised more fundamentally is that there's obviously been lots of talk about using, large gas turbines or large nuclear plants or small-scale modular reactors that, again, produce quite a lot of power to feed data centers. And you mentioned kind of this question about the grid and kind of balancing supply and demand. And I think this is really, really important here, because if we end up in a situation where actually data centers do become much more efficient, but singular data centers are being powered by quite large, less flexible sort of profiles of load supply, that can start to be more problematic in terms of the flexibility at which capital is deployed. Again, the beautiful thing about renewables, particularly when you combine them with storage, is that you have dispatchable power. So actually, if suddenly a particular data center or cluster of data centers becomes much more efficient in terms of their energy use, you can kind of work out how to move that energy around in a way that, again, a singular nuclear plant or a singular gas plant producing quite a lot of load maybe cannot. Again, you'd have to essentially build lots more data centers to end up meeting that particular kind of supply of load. So DeepSeek was sort of fascinating for a number of reasons. As I say, there was a valuation impact, there was a fundamental impact, there was sort of a new technology that slightly changed the way we think about things. And again, I'm sure we can unpick some of these things as we kind of go through this conversation. But again, I would stress that it was a relatively information light release. And certainly, again, we probably still need to find out a little bit more about exactly how that model was trained to kind of get a fuller extent as to whether it is as efficient as it ultimately was suggested.
Can you just give us another minute, Alex, on data center demand and AI in Europe? Because when we hear about it in the US, most of what we hear in the US is that there's a China-US AI race, and no one even mentions Europe at all. So can you just give us a sense of kind of what the tenor is, the investment themes going on around Europe, around AI right now, and data center build out?
Yeah, so I think it would be fair to say that we've certainly seen this build out happen first in the US, or at least at a greater speed in the US. And to some extent, that's not a huge surprise in that, again, a lot of the hyperscalers are based in the US. That's probably where we've seen some of these sort of, initial models, come online. And also, I think it would be fair to say that generally, when we think about sort of load growth, maybe the US has sort of been underinvested in slightly more, or we think about kind of that relative balance of sort of energy supply. But that isn't to say that there is lots of activity starting to happen in Europe. And one of the markets that sort of, I guess, I follow relatively closely just based on the sort of companies that we look at is Spain. And we're seeing quite a lot of potential data center development brewing, I would describe it, not necessarily sort of full deployments yet that we maybe are seeing in the US, but brewing in Spain. And Spain is a really interesting market from a sort of data center perspective, because one of the things that Spain has is probably more days where you have totally free power. The power price goes to zero in the spot market because of how much renewables are in the Spanish market, and how, particularly when we think about solar. So what we are sort of starting to see in Spain, and again, this is kind of what's interesting, I think, in the context of sort of renewables and AI, is data centers being set up to kind of soak up some of that excess renewable capacity at a very, very cheap price. And again, I think that's why Spain is being targeted as one of the sort of big markets for data centers in Europe, because again, we do have that abundant, cheap at a marginal cost perspective power. Now, again, ultimately it won't be cheap. PPAs will be signed, and there'll be a sort of more fixed price contract. But again, an interesting example of where I think the early signs of data center development in Europe is happening. Because again, when you think about populations and the ultimate end users of AI, Europe is going to be a big part of that as well.
Great, thank you, Robin. So maybe we can start adding in, because we're focusing a lot on data centers, and this is AI for the investing future. There's kind of two ways that this goes. There's like this fork in the road where AI goes to the whole energy demand, infrastructure, and supply chain. But then there's also where AI goes because it is changing investment thesis along all types of businesses, including that supply chain. So maybe you could talk to us a little bit about what you see as AI, not just as this load-bearing thesis, but also as this investment thesis of what it's doing to traditional power grids and traditional investment theses as well.
Yeah, absolutely, Jeff. And it's interesting. I read an article this morning that AI is being used by a lot of battery developers, for example, to find the most optimal configuration when it comes to solid state batteries, which are going to be commercial in a few years, could really alter how we look at the battery space. I mean, for example, we saw a few days ago that BYD is offering a car that could charge in about 5 minutes, which is on actually doing a gas-powered car. So with that being the case, we're seeing all this innovation go into very specific areas where, as Alex had mentioned earlier, really increasing efficiency, right? And the AI argument is going to be, well, at the end of the day, it has to be profitable and it has to earn back its cost of capital, right? So what's the actual consumer implementation? We're seeing that in a lot of spaces. We're seeing that in the pharma industry, for example. I know your previous speaker actually talked about AI agents, and that's going to be a really big space when it comes to actually interacting with the end user, right? That's going to be a high growth area. So software applications there could be interesting. For our mandate, just looking at the climate space, we're absolutely seeing it on the ground when it comes to how weather patterns are being more accurately predicted, for example, and biodiversity initiatives. And you can do a lot more data crunching there to get to the end result. But for us, it has to make economic sense, right? And Alex had alluded to this earlier. There was this gold rush in this space, and the valuations were extreme. Now with the DeepSeek news flow and a rethinking of CapEx, valuations have come down to more reasonable type of levels. And now there's a price point where a lot of people, I think, are interested from both an investor standpoint and from a company standpoint, right? So we are seeing that integration happen. The speed of that is happening, I think, more overseas than the US. I mean, we're seeing a lot of Asian companies really take the baton and go. For example, Japan, I think, is kind of an underappreciated play here when it comes to using AI into kind of their everyday type of businesses. Europe, as Alex had mentioned, is really going up the forefront as well. So I think there's an investment opportunity for the US to catch up to where everybody is over the next few months.
Can you tell me a little bit too about how you think about nuclear, because I
Yeah.
mean, there's multiple different ways that you can kind of get at nuclear. You can get at nuclear from a mining perspective, or now there's the SMR space, or now there's, Constellation and Cameco, bigger nuclear players. Where do you see the biggest opportunity or risk in that space? Either side, where valuations have maybe gone too crazy.
Yeah, absolutely. I see more risk than opportunity, Ashley. I think there's a lot of hype in the space, and a lot of players have seen this as a quick fix to all the issues that we're talking about, because it's fairly clean energy, and you can actually build it pretty fast is the whole perception, but that's not actual reality on the ground. I mean, if you look at the news flow from the prior year, Constellation Energy, for example, and they wanted to restart the 3 Mile Island plant. That's not going to be operational until 2028 and maybe even 2029. Small modular reactors could be used also behind the grid to power data centers, but there's only 2 of them operational in the world right now. One's in China and one's actually in Moscow. So, it's not going to be commercial for another 5 years. And we know there's a bottleneck when it comes to nuclear engineers. There's not enough out there. We know it takes years to get new capacity in play. We know also Kazakhstan, Russia have a lot of the enrichment capabilities, and you need kind of like low grade also uranium to even do small modular type of reactors. And Russia has a chokehold on that. So there's a lot of geopolitical issues in play here, meaning it's not going to be as quick of a fix as what the market is expecting in just the valuation. So you saw all these small companies that are not profitable, that are public entities, do extremely well last year on this kind of hype cycle. And now they're starting to come down to earth and come down to more reasonable type of valuations. They're still not profitable, and they're not going to be profitable for many years, right? So you're actually buying a lot of hopes and dreams. So I'd rather play a multinational company, like, for example, Hitachi, which has multiple type of lines of businesses, just so happens to have a nuclear type of division as well, have a joint venture with a GE here in the US. And that's kind of, to me, a slow and steady, stable way to play the space, as opposed to trying to hit a home run with a small cap company that's not profitable.
Great, thank you. Alex, sitting over in Europe during the current geopolitical situation that we find ourselves in, I was wondering the other day if nuclear, especially on the uranium side, becomes more of a play, just because more countries are going to start thinking that they have to defend themselves as well. And maybe that's a better way than playing some of these small startup companies that you're hoping get SMRs to work quickly. But maybe you could touch quickly on that and other broader themes that you're seeing within the investment space.
Yeah, I mean, I would totally agree with everything that Robin sort of touched on there, in terms of I think the sort of revival or renaissance that we're seeing in nuclear is a real thing. Ultimately, nuclear, in terms of the profile of power supply that it can provide, does make a lot of sense for data centers that require 24/7, very, very reliable, low carbon power. Nuclear is an attractive solution on paper. I think what we've seen is that on paper is one thing, and I say we're very good in the UK on this. We have a couple of reactors that are very much over budget and over time being built. These things take, are often very expensive, sort of post build, if that makes sense, and often take a little bit longer to do it. So I think we've always sort of suggested that, yes, nuclear will have a role. I think we will see these SMRs, but again, to Robin's point, we're not going to see these post 2030. So that's a long time to wait until we see some revenues, let alone some sort of profitability for some of these businesses. And I would absolutely agree on the sort of geopolitical side of things as well. Part of the reasons that renewables are in some ways so attractive is that you can build, by and large, a solar plant anywhere, and a battery anywhere, and a wind turbine anywhere, and you don't need to rely on the fuel that is often concentrated in lots of parts of the world. Okay, we could argue that rare earth minerals that go into batteries and renewables are situated in parts of the world, but again, certainly in terms of the abundance of that supply, it does matter. So I would agree that nuclear is interesting, but if there are ways to play it that are less risky, possibly are interesting, unless the valuation makes sense. And I think that's probably where I would end on my side. And it's been fascinating watching both the conventional energy and sustainable energy space over the last 5 years. Because, if you go back to 2017, 2018, and sort of through 2019, 2020, renewables, re-rated dramatically. I think we will look back at sort of the great renewables bubble the same way we probably look back at the dot-com boom and bust a little bit in 2000. We will, well, already we are, because those valuations have retraced all the way back down. And equally, conventional energy, if you go back to 2018, 2019, nuclear, gas, was on its knees. You were looking at things like Constellation and Vistra trading well below book value. And equally, again, renewables names were probably 3, 4, 5x times book when, that fundamentally didn't really make any sense. What's interesting now is we've totally reversed that, where some of these businesses in sort of nuclear, gas, sort of baseload power are trading at probably multiples that are far too high, and some of the hype is embedded in there. And equally on the renewable side, we've totally retraced the other way, and we've sort of now taken a view that renewables aren't going to be grown at all because of politics, because of the need for baseload power. We've sort of forgotten all the things that are true about costs and demand and the need for flexible power and innovation in the space. So, one of the things that I think is always super important when investing in, I guess, the clean energy landscape or the energy landscape is that, and I guess investing generally overall, is that valuation matters. And yes, earnings momentum and sentiment does influence things in this space, and that's important to be aware of. But at the end of the day, it's about, can you find businesses that can generate a sustainable long-term return? Because they're the ones you're going to want to hold for the long term, and they're the ones that are going to be successful. And when things do get expensive, yes, they can always become more expensive. We know that through history. But equally, that they can suddenly become very, very cheap very, very quickly, and we've seen that with renewables. So I think that valuation discipline, and to Robin's point, trying to find businesses where you do have that sort of stability of earnings growth, or at least the risk reward is attractive. And that isn't to say that small scale modular reactor companies that are unprofitable today can't make a fantastic return at some point. It's just thinking about what's priced in and where that risk reward sits.
So Alex, maybe we could add in a theme that we haven't talked about yet, which I always think is consistently undervalued, and the demand for it is just going to grow exponentially, and it's a limited resource. Can you talk a little bit about water and the impact that data centers and just the traditional investment theme, even around water, even prior to data centers, maybe is having right now?
Yeah, I think this brings up an interesting broader question of, I guess, the sort of environmental impact of data centers and just the environmental impact of building out all this infrastructure. And water is obviously a big part of that. We do see enormous amounts of water usage for some of these large scale sort of, I guess, energy infrastructure. You ultimately need to cool things. Nuclear is a fantastic example of that. And actually, when you looked at France during the energy crisis in 2022, it should have been a country that was exporting all of its power to the rest of Europe during an energy crisis. But it was also a year where we had very, very hot weather in Europe. And actually, they couldn't cool their reactors because they didn't have enough water, or they couldn't keep those temperatures down. So I think when we think about the constraints to building out this infrastructure, water is absolutely part of that. And again, there are going to be winners and losers from that. If you're a company that can help provide some of that water or recycle some of that water or be involved in that water infrastructure, bringing it to site, there's some potentially really interesting investment opportunities there. And equally, there are going to be losers on the other side in terms of, if you can't get that access to that sort of, I guess, resource, that's going to be influential as well. But I don't think it's just water. It kind of brings into the question of, I think Robin mentioned this earlier, space. Where are we going to build this stuff? Can you build this stuff and also connect it to a transmission line and build that transmission line? Because that's going to be super important as well. And that brings into things like copper and sort of, other sort of, I guess, scarce resources to some extent that are only going to become more scarce. So, I think one of the things, and we've seen this with some of the supply chain disruptions over the last couple of years, we're seeing it a little bit with tariffs, thinking about the constraints to building all this stuff, which might sound great on paper, again, is a really, really important thing to think about. And again, I think in those constraints, companies that solve those constraints, they tend to be good investments. And equally, companies that are sort of really inhibited by those constraints, they tend to be ones that will have earnings bumps and potentially investment bruises, if that makes sense. Robin,
want to give you a chance to tackle that too.
Yeah, Alex is my new best friend. I agree with everything that he said on that. Water is a really big deal, and we're spending a lot of time on it. I mean, for example, a mid-size data center will use about 300 or so thousand gallons a day, which is about the equivalent of about 100,000 homes inside the US per day, right? So it's a very big type of water footprint. Cooling's about 40 or so % of the power demand inside of a data center. So as these data centers grow, the cooling need is going to increase as well. And we're doing a lot of work on, for example, air cooling going to liquid cooling, and how much water is that going to require. And this is going to be a global issue as well, right? So how they solve that, and the companies that are offering these solutions, I think, is the play. And it's a broader point on where you want to invest right now, right? I think the first leg of this AI rally happened with semiconductors and chips and that whole area of the space. Now it's going to more of the picks and shovels and exactly how you do this, not just the cooling, but the racks, the servers, like who makes that infrastructure, the grid, as we talked about, and how are these all going to be upgraded, right? So I think we're going to see that next wave into the space, and water is going to be an important part of that, and how you solve it is going to be crucial investment opportunity, we think, over the next year.
What other investment themes are you looking at right now?
We're really focusing on grid infrastructure and just the certain parts of the grid infrastructure aspect of it, because there is an energy efficiency aspect that really improves climate change at the end of the day, right? So that's a key focus. We're looking into buildings as well, and just being able to upgrade and retrofit a building makes a big difference when it comes to climate change on just emissions overall, because we know that the buildings are a big part of it, right? So essentially insulation, how you allocate energy inside of a building, how you allocate water inside of a building, and just the proper type of management of that could be a real game changer. And there's a ton of companies that are offering all sorts of solutions to that. This is an area that not many people are talking about, but it's a needle mover. And Alex and I think we agree on this. We're always looking for the inefficiencies. Where's the market not focusing where there's an economic opportunity and there's a lot of fear or worry around it? And as an investor, that's where you want to go into, right? So, and also the EV space, especially the non-US EV space, we think is an interesting area right now. We're seeing all the news flow from the Chinese EV companies. We're seeing Europe trying to take some initiatives there as well. We know what's happening here inside the US, but there's a lot of positive EV traction happening non-US that I think investors should be interested in.
I won't mention Tesla. So I'm curious, of all these companies that you're looking at, when you're looking at newer companies coming to market, it's just so interesting because we're talking about AI as an investment and how it's impacting the future. But at the same time, when you're looking at grid infrastructure and you're looking at the built environment, how many of those companies are also AI companies that you're looking at now?
Not too many. If you take a look at the Venn diagram of just AI companies, and then you do it with the space that we're looking at, there are a few companies that do cross that line, but they're more of solutions type of providers, meaning they're not going to be NVIDIA or Apple or Microsoft. We see climate funds, for example, own those stocks, and I think they can make a case for them. For us, we want actual profitability tied to scaling a climate solution and actual economics tied to that climate solution, as opposed to them being a company that hires somebody to do that in a way, right? So that product or business line has to be tied to that solution. In that type of diagram, for example, like a GE Vernova, which was spun out of GE about a year and a half ago, would be an example of just kind of an all of the above type of energy policy company, to where they have natural gas as a bridge, as just a bridge fuel, but they also have a nuclear division, as I mentioned earlier. They've got solar, they've got wind. They check off a lot of boxes, right? We're finding those type of companies. The world has kind of rethought all of this and said, all right, it's going to be an all of the above policy type of initiative, right? You're going to have natural gas hand in hand with everything else. And we need to improve that because we have these needs from data centers and electricity base loads improving. And you can't just go 100% on renewables, right? It's not going to be practical over the next year, right? So then which companies are going to help solve that, is what we're trying to find. We're also finding a lot of cooling companies as well, right, that are actually involved in that type of technology where you shift from air to liquid type of cooling. Example of this, going back to Javon's paradox that Alex had mentioned, is kind of the use of a refrigerator in your home. When you first bought a fridge 40 or 50 years ago, it was very inefficient, right? And you couldn't really say it was energy efficient. But then there was a lot of, technological improvements. And now you probably have a fridge in your kitchen, in your garage, and probably a small one in your den, right? So the amount of fridges have increased in your home because it's become a lot more efficient. So actual refrigerant usage increased, while it became more efficient, right? So those type of companies that can do that for a data center, for example, right, and offer those type of solutions to cooling. So we're spending a lot of time in the HVAC space, and there's a lot of traditional like HVAC AC companies that are trying to pivot to this area and say, all right, now how do we solve this data center issue? How do we do the same thing we did with the fridge to a data center, right? That's a really interesting space for us to take a look at right now.
Awesome. Alex, same question really for you. What are some of the broader themes that you're looking at? And maybe I can rephrase the question that I asked to Robin. And I'm curious, how many of your due diligence meetings now that the companies that you're looking at are at least talking about how they're integrating AI into their business models?
Yeah, I think one of the things that excites me most about that sort of juxtaposition between AI and energy in particular is if we think about the problem that we're ultimately trying to solve here, it's how do we balance supply and demand of power while also trying to decarbonize it as quickly as we can. And to Robin's point, at the moment, we can't necessarily chuck loads of renewables at the grid because actually balancing that supply and demand in an environment where you have loads of renewables, and for some cases like data centers, you need 24/7 power, very, very difficult. Now, if I think about what AI is fantastic at, it's about solving that exact type of problem in terms of if you have lots of resources of energy, whether it be big centralized sources of energy on the grid, which could be gas, nuclear, renewables, or whether it be energy sat within our homes, solar on our roofs, our EVs that are plugged into our walls, even some of our appliances. I think one of the most exciting things about AI over the next couple of years could just be the ability for AI to help solve that problem and actually work out how, with all these different types of energy resources, whether it be on the demand side or the supply side, how can we use AI to help balance that equation around supply and demand? Now, that might be, okay, actually, look, we've got tons of electric vehicles plugged in here that aren't being used. Let's extract some of that power that's charged in those vehicles, use it, and then give it back to the cars when they need to be used. Or, we're currently at home and we're not really using the dishwasher and we're not really using the fridge and we're not using the surround sound TV or whatever people have in their homes these days. Let's take some of that power that was being produced by the solar on my roof and give it back to the grid so that we can meet demand elsewhere. And equally, it might be a case of, okay, actually suddenly demand is ramping up. We've got to pull all that demand together and work out how to kind of move it around in a way that's more flexible. So I think the use of AI to help that balancing equation is going to be really, really interesting, not just as a way of solving blackouts and improving energy efficiency, but also unlocking the potential of renewables. Again, the one problem that renewables have is that they are volatile in their load profile, and so therefore matching supply and demand is more complicated. But if you can find ways of helping to solve that problem, actually the demand for renewables becomes increasingly attractive because you don't have to worry about the balancing costs, which are sort of what sometimes make renewables a little bit more expensive. Actually, if you can reduce the cost of balancing, renewables become an even more attractive economic proposition. I think we'll see demand grow. So again, I think that is a really interesting nexus. And there are a few companies sort of in grid tech and, but we're even starting to see, some of the kind of, traditional renewables businesses think, okay, look, how can I build this into my model? Or energy storage businesses that maybe weren't using AI so much go, okay, how can we use AI to produce a better solution? So I think there's some of the things that I think are most interesting.
I just want to add too, because you talked a little bit about like solid state batteries before, but are you seeing battery technology rapidly improving? Because that certainly is a huge game changer for renewables as well. It's not just that the AI can help moderate the base loads and everything, but it's also, can you store that energy on site efficiently so that it can be released on demand and not have these periods where you need natural gas peaker plants or other things to back up renewables?
Yeah, I think absolutely is the answer to that. I mean, we're seeing lithium-ion batteries get more efficient, more power dense, and have longer duration. So, historically, maybe when you were installing a lithium-ion battery, you had a battery that could deploy for 2 hours and then sort of ran out of juice and needed to recharge again. Now, kind of the standard is maybe 4 or 6 hours, and we're starting to push longer than that. And that's with lithium-ion batteries. We're seeing huge amounts of innovation in longer duration energy storage, whether it be flow batteries or mechanical batteries or compressed air or whatever it may be. Now, these are quite expensive at the moment, but ultimately, I think, again, we're going to see them become cheaper and cheaper. And again, that gives us the ability to store renewable energy for a much longer time. And again, that's going to help improve that economic profile. And then, as I say, I think what we're also seeing is batteries becoming more intelligent in terms of their understanding of when to store, when to deploy, how to optimize the yields for users, be it us in homes with backup storage, or utilities kind of trying to manage the whole grid. So I think that battery technology is so interesting at the moment. And if I can I always use this analogy a little bit, right? Like, we first invented the battery in like the 1970s or whatever, and the first sort of lithium-ion battery. And then basically what we've got good at is making them a bit bigger. Like, that's really what the lithium-ion battery in a car, or even the ones on the grid sort of are.
Right.
Now we're into this phase where it's like, okay, how can we really make these great? In terms of really being able to be functional, in terms of whether it be range in our electric vehicles, speed of charging in our electric vehicles, but also what's going on in the grid. So, batteries are ultimately sort of the thing that unlocks renewables more than anything else, because it allows for that storage and reducing costs. So again, I think that will remain a super exciting area.
Robin, we've got about 4 minutes left, so I just want to make sure that you talk about kind of your best investment ideas right now, before we wrap up.
Yeah, Jeff, absolutely. It's a very interesting time right now if you're an investor. Of course, you've got the volatility, right? And volatility always, leads to opportunities if you're a long-term investor and not a speculator at the end of the day, right? With that type of framework, you want to look at the areas that are the most profitable. We look at free cash flow, for example, like how much cash is actually there at the company after all their bills are paid, right? It gives the company a lot of flexibility. In that type of framework, take a look at water. And the water type of names, it's not just the data center opportunity, but there's the water scarcity issues everywhere, right? And we're looking at a lot of desalination plays, for example, and there's going to be a forever chemicals type of cleanup opportunity as well for a lot of companies over the next year or two. So that's one area we're spending a lot of time on. When it comes to grid, it's a bit more complicated. You really have to isolate the product you're looking at, whether it's the cable or the transformer or the high voltage line, and understand what the tariff impact could be to that. And that's kind of a known unknown, right? We really don't know what's going to happen the first week of April, whether it's going to be a negotiating ploy or not. So it's very hard to build a cash flow model around that, which you may need to change that from time to time. So you can probably be able to pick your spots on there, I guess I'm saying, over the next few months as well. As far as also regions go, Japan, as I mentioned earlier, is a very interesting player, I think, in the space. And they kind of missed the battery opportunity that Alex had mentioned earlier, right? It was really the Koreans that took the leading stage on that. But now the Japanese companies are really spending a lot of R&D under the battery side and making a lot of innovations when it comes to solid state. So I would take a look at a few of the Japanese companies there in play as well. And I know it's a bit controversial, but China is very interesting right now, when it comes to valuations, when it comes to traction from a policy standpoint. Of course, we know the geopolitical issues, and I don't need to educate anybody on that, but just the investment opportunities, I think, at this point in time. And you've seen the outperformance year to date, China and Europe against the US, and we're seeing a pullback from the Mag 7. We're seeing a pullback from a lot of the US AI names, and we're seeing capital actually flow to non-US areas. So if you're a dollar-based investor, that's a really important point, right? You really want to see where the flows are going, and a lot of people are hedging their dollar exposure accordingly. So, I would take a look at those areas from just a regional standpoint as well.
Yeah, I won't get political, but if you alienate your trading partners, those investment dollars tend to go somewhere else. Alex, you've got about a minute to wrap up on your side.
No, look, I mean, I totally agree with everything that Robin said, so I don't want to repeat too much. I think I always think about this space kind of again in different buckets of risk reward. There are certain parts of the space where realistically earnings are probably going to keep performing relatively well, and grid is a good example of that. Regardless of what power we're bringing on, if power demand is going up, we're going to need a grid that needs to sort of manage it. And then I think it's getting that balance right of attractive valuations in parts of the market that are unloved, and equally, when the time is right, sort of looking at some of those sort of newer, more exciting areas where again maybe that risk reward is that sort of risk is a little bit higher, but the potential reward is higher too. So one of the areas that I suppose we haven't we touched on it a little bit is just renewables. The traditional renewables businesses, because actually sneakily when you look at their cash flow generation today, a lot of these businesses have grown up. These are businesses that maybe historically weren't generating loads of cash, but actually if you were to look at the cash flow generation that a solar tracker company is generating, or even a wind turbine manufacturer is generating now, they started to have the ability to buy back shares or pay a dividend for the first time. And, that's unheard of really in this space. And again, sort of reflects the valuations that we've gotten to and why I don't think we should necessarily rule out some of those sort of, traditional sort of renewables names as well, which I suppose we haven't touched on too much. So that would be maybe where I leave things.
Awesome. Guys, thank you so much. Excellent job. Alex and Robin from ScopeFour Capital and Schroders. You guys were excellent.